David, thanks for taking the time to meet with us again. We've just had the investment committee meeting for the quarter, only last week, and the rebalance has happened. So not a lot of change to the portfolio. One little thing we did see was introduction of momentum.
Yep.
Can you explain momentum, what that actually means in the context of that particular ETF?
Yeah, so momentum is one of these factors. It's like a factor. It's a quant process overlay within markets, which historically has generated outperformance. So if you screen stocks for momentum, i.e. companies with above average price returns, in the case of MTUM, we use a 12 and 6 month price performance, and we take an average. And basically you take the top companies within the market that are outperforming on price. The ETF gives you exposure to that. So momentum alongside things like quality, value, it's one of these metrics which generally speaking over time generates outperformance. And the other advantage of momentum is it has a nice, in terms of when it performs, it's a nice mix to have it against something like value. So when you get a reversal in markets and momentum, things that were doing well don't do well. The things that tend to have been neglected and are cheap, i.e. value, then they do well. So by blending them within the portfolio, it helps reduce the tracking error to the overall market as well. So that's what momentum is. And we have the ETF MTUM, which is going to be part of the Australian equity sleeve of the portfolios.
Can you give me two examples of stocks that are currently in there and a bit of the
Sure.
why?
Yeah, so for example, if you look at sectors in the Australian market, financials have done very well over the past year. Resources haven't done so well. MTUM by that nature is overweight financials. It's underweight resources, and some of the two biggest companies in terms of overweight relative to their market cap index are Westpac, as an example, and Macquarie Bank. Underweights would be BHP. As a major resources company. So again, MTUM doesn't have any BHP because it's underperforming, and CSL. So that's, in terms of overweights. And at the moment, MTUM, likes financials, doesn't like resources so much.
Right. So I see, interesting enough, you mentioned Macquarie there, which is also in quality, or AQLT, from memory.
But Macquarie's, a great company. It's in different ETFs for different reasons. So it's in quality simply because you screen companies by return on equity and leverage. It ticks the boxes in that sense. So at the moment, Macquarie is well represented in the portfolios, both from a quality perspective and a momentum perspective.
Okay, this is always an interesting one, a conversation you and I have regularly. Gold had a stellar run since it's been introduced to the portfolio.
Yes.
Is there anything in the future that you see might lead to a reducing the exposure to gold in the model?
Look, gold's done very well again in the past 3 months. I think the ETF itself was up 7%. And look, underpinning it is at the moment central bank buying. There's different reasons to buy gold. Like if the US dollar was weakening, if bond yields were falling, ordinarily that tends to be a good environment for gold. But it's actually done very well even without that happening because of central bank buying. So at the moment, it's doing well. Central bank, basically what we're seeing globally is that many central banks, particularly emerging market central banks in Latin America and China, want to diversify their reserve holdings. They don't want to they want to hold something beyond just US Treasuries and US dollar. And so they've been buying twice as much gold as they normally do over the past couple of years. And at the moment, we don't see any reason for that to change. I mean, so in terms of your question, would we underweight gold? Look, if gold started to underperform, it started to break down technically, or we saw some evidence of central banks buying less, obviously reconsider it. But at the moment, it's doing very well in all manner of market conditions because of the central banks being the big driver of it. Right. So until that changes or some other macro factor changes that outlook, we're happy to have that exposure.
This is the question on everyone's lips: the Trump effect. So the tariff conundrum. What's going on there? We're up, we're down. We might not. Obviously, causes all manner of issues for the committee in terms of how the portfolio is positioned. What are you seeing? What's the probably key takeout at the moment? I think you spoke that Trump's not going to necessarily do anything that's going to damage the US economy, but at the moment.
We hope. The way we look at it is Trump to one side, the macro economy globally is doing pretty well. Growth is still resilient. Inflation is still coming down. In fact, the early inflation reports for this year have been pretty good. Annual inflation has started to come down. So were it not for Trump, it'd be happy days, and we'd still be pro-risk and looking for good returns in both equities and bond markets. Now you bring in Trump and tariffs are a tax on imports. They add to prices, they hurt profit. He seems to think they're a good thing for the economy. No economist in the world thinks they're a good thing. So look, as a committee, we you have to form a judgment. Is he going to basically risk the US economy, risk Wall Street by pressing ahead with tariff increases? He could impose the tariffs and the markets take it pretty well. The Fed looks through the short run increase in inflation and it doesn't disrupt markets too much. Or he could press ahead and it does disrupt markets. But then ultimately we figure that he would pull back, because he's not crazy. The term we use, Trump crazy.
Yes.
In some respects, people might think he's crazy, but we think in terms of just deliberately damaging the economy and the markets, I don't think he would be. So if push comes to shove, our judgment is that he will pull back. But look, what it probably means in the short run is there may be some volatility, even some market weakness. Again, it's very hard to get too cute in terms of timing portfolios with that because it may or may not happen. What you don't want to do is panic and the markets are off 5% from their highs and you go underweight.
100%.
He changes course and the markets boom and you miss out on that performance. So our strategy in that regard is, look, if he does something that we think is going to seriously risk a US recession, or seriously risk a major downturn in corporate earnings in the share market, to the extent we can get out ahead in front of that, we'll look to reduce risk in the portfolios. If we do get a sell-off in markets, which we think is unwarranted, and things look like turning around, that could be a great opportunity to add risk to the portfolios. So you're looking at it from two perspectives there.
What have we had? So 2024 was a good year overall in markets. 2025, and obviously that's an issue. I think Europe's doing quite well.
Yes.
As we speak. US, the last couple of weeks haven't been great, in the Australian market as well. Outlook for 25, notwithstanding what we just spoke about.
Yeah, I mean, it's again, the broader picture over the past few years has been the soft landing scenario, inflation coming down, central banks moving to cut interest rates, economic growth and corporate earnings remaining resilient, which has been a good backdrop for both bonds and equities. At the moment, that is still, the underlying base case. Again, it comes back to, is Donald Trump? Hard to believe it, but really the only risk at the moment, the material risk, is Donald Trump and his policy action. So unless he goes crazy on that regard, the outlook is still good. And as you mentioned, I mean, one of the things we're seeing is a rotation, again, early days, but maybe this long discussed rotation from US market to non-US market. So Europe's doing well, China's doing well. A couple of reasons for that. Firstly, just in terms of Donald Trump and the threat that he won't provide the defence umbrella to Europe in the way the US used to. A lot of talk in Europe about boosting defence spending. Also, just in Germany, they've had new elections and the government there is now talking about trying to boost fiscal spending. They've got to change the legislation there. It's not easy. There's legislation in Germany to reduce the amount to which they can run a budget deficit. He wants to change that. So there's a lot of excitement around fiscal stimulus in Europe. Meanwhile, in China, you've got the Chinese authorities now warming again to tech entrepreneurs and focusing on the technology sector. DeepSeek, of course, has been another development in the last few months, which is, I guess, questioning the dominance of the US tech companies in AI. We used to think we needed very expensive computer chips, a lot of computer power, the sort of things the US were really good at. But maybe there's cheaper, simpler ways to do AI, and that's maybe what the Chinese are suggesting. But either way, it's helped with the shift in Chinese tech doing well, US tech not doing as well, and so it's part of that shift. But broadly speaking, equities are still beholden to Trump, but we could be seeing at least under the surface, a shift from US to non-US markets.
It's been a while. Europe's been in the doldrums for some years relative to the US market. So.
Yeah, US has been outperforming almost everyone over the last few years. It's got to quite an expensive level, relatively speaking. So Europe, emerging markets have been cheap for a while, but we didn't have a catalyst. Markets were struck. What will be the catalyst for a rotation to the cheaper parts of the market? Donald Trump and the shift in the defence outlook is one, DeepSeek is another. Europe deciding it needs to engage in a bit more fiscal stimulus is potentially another stimulus as well. At the same time, Donald Trump and Elon Musk are talking about cutting spending, Yes, he wants to cut taxes, but he also wants to cut government spending. So there could be a shift. Another thing investors are talking about now is a shift in the fiscal stimulus. So US is less fiscal stimulus, Europe more fiscal stimulus, and so that, again, another potential catalyst for that rotation within those markets.
And you talk about the US, David, and I think that must have been the last or community before that, you added QUS into the portfolio.
Yes.
So the equal weight.
To the extent the large cap tech areas of the US market, the NASDAQ, for example, those sort of NASDAQ companies underperform, then our expectation is that the equally weighted US exposure will help offset that and outperform. So again, we're potentially seeing a rotation not only between the US and non-US, but within the US itself, large cap tech to more of the value parts of the market. So financials, for example, are doing very well globally. That's good for Europe, it's good for US, it's good for the equally weighted exposure. Look, bottom line is the portfolios are pretty well diversified in lots of different areas of the market. That if one doesn't do well and others can take up the slack, and certainly the models have good exposure to non-US markets and smaller cap non-tech US companies as well.
Yeah, which is significant, and really for the clients, and we talk about this all the time. It's that don't put all your eggs in one basket. That diversification across the portfolio is staggering.
Yep.
Both, as you say, geographically, but also within markets as well. So momentum is another one that we started off with. So.
Yep.
It's good protection mechanisms to an extent, I guess we're talking about. Crowd favourite, clients, interest rates, outlook, particularly domestically. Obviously, a lot of people still beholden to what happens there. It's always an interesting question. We had a cut last month now. So outlook, what are we thinking? There's been a bit.
Yeah, look, it comes down to the inflation outlook. So, we had a very good December quarter consumer price index report. It came at the annual rate for the underlying measure of inflation was 3.2%. The RBA thought it'd be 3.4%. The RBA's, I thought it was a no-brainer. They would cut rates in February. They said, they were umming and ahhing about it. But I think it was a pretty clear cut case. I think they just want to dampen expectations of people getting too excited about rate cuts. But look, the case is there because inflation's coming down. There are RBA's own forecasts are for underlying inflation to get to 2.7% by the June quarter report, which comes out in late July. So if we get continued declines in inflation, I think there's every reason for the RBA to continue to cut rates. So I've still got them cutting rates in May and then in August following the next two quarterly CPI reports. Interest rates in Australia are still at restrictive levels. They're above normal. And B, inflation's coming back down to the target band. So as it comes back in the target band, you renormalise the rates. I mean, you don't have to it's not much more complicated than that at the moment.
Risk to the inflation outlook though? Key risk for us?
If the economy rebounds strongly and we get a pickup in wages growth, there's some, lingering pricing pressure in the services area. If the Aussie dollar slumps and it leads to import prices going up, there's some upside risk to inflation. But look, the big news, the good news in Australia is that unemployment over the past years hovered around about the 4% rate. It's been low. Employment growth has been very strong. But wages growth has come down. It was at 4.3% in late 22. It's now down to 3.2%. So wages growth has slowed even with unemployment where it is. So that tells me that, we don't need to see the unemployment rate maybe go up to 4.5% as the RBA once thought. Yeah. Maybe 4% is good enough. 4% is consistent with wages growth coming down and being consistent with inflation, getting back into the target band. Whereas I think a year or so ago, the RBA thought we needed to see the economy weaken, we needed to see unemployment rise. to be confident inflation's coming down. But I think that, what we've seen over the past 6 months to a year is maybe we don't need 4.5%. So look, there's always risks, but at the moment, we are. Again, we're not looking at tariff increases in the way the US are, so that's a price shock that we won't have to deal with. If anything, like it's a negative, trade wars globally do break out and global growth is dampened, it may add to the case for the RBA cutting rates.
The other one was, you spoke about the DeepSeek, the AI. There's a lot going on there. NVIDIA had a bit of a tumble in recent times with the DeepSeek. In terms of that impact, and if we think about exposure to Chinese markets, I suppose with the likes of DeepSeek, obviously a whole lot of other issues where we're dealing with security and so on and so forth. Access to those markets?
Again, the portfolios, we do have exposure to emerging markets through the non-US parts of the global equity sleeve. So definitely, the portfolios will benefit from that exposure. But again, we have a very, the models have a very well-diversified exposure across global markets. So if one's coming down and the other's going up, it's going to provide a nice offset.
David, once again, thank you. A great conversation, and look forward to catching up in a few months' time and carry on it again.
No worries, Jason. Great to be with you. See you next time.
Cheers.